All right, so homework 13 is due on Monday, and we're going to continue talking about inflation today. And then there's a little bit of a gap as far as the homework goes, and you can turn your focus to finalizing the project, which is due a week from today. And I've had a couple of questions about the report and the formatting of the report, and so what I'll mention is that the report should be broken into sections that mirrors the sections in the assignment description. So you should have, section 1 of your report would be income. Section 2 of the report would be your ordinary expenses. Section 3 would be the extraordinary expenses, and so on. As far as the citation method, I don't care if you use MLA, APA, or another method. The main thing is that when you have used an outside reference that is kind of your authoritative evidence of a certain thing. So for instance, if you have salary data, then cite it in the body text, and then at the end of the report you have a list of references. And the list of references at the end of the report shouldn't include every website that you looked at. It should only include the references that you're actually citing, the ones that you're referring to in the body text. And somebody asked me recently about how long should it be. And so the default line numbering in Microsoft Word is 1.15 spacing, I think. So it looks like single space, but it's a little bit more spread out than single space. And the default font size is 11. So if you have those defaults in Word, then I think probably 5 pages, maybe a bit more, is adequate to describe what you've done if you're kind of just looking for a middle-of-the-road effort. Now, a lot of people have gone into some pretty interesting detail and maybe developed their own regression analysis for the increase in salaries in their field. So if you've done something really spectacular, then it's probably going to take a little bit more space for you to describe that to me and show me, in what way you've been excellent. And then when you insert figures or charts, tables, screenshots, if there's things that you want to refer to because it helps to make the point, then that's also going to make it longer than just the 5 pages. I was thinking 5 pages in terms of your description and the text, talking about what was your assumptions, what method did you use for calculations, and so on. So there isn't a page minimum or a page maximum, but what I'm just looking for is how did you make this project your own, and how have you really done something above and beyond just maybe the few references I showed you in class. I showed you the basics to kind of whet your appetite and illustrate what kind of data is out there. And as I've talked to different students, I've been kind of struck so far by how everyone seems to be really emphasizing a different section. One person is really going into a lot of detail on the expenses, and then kind of just maybe a middle-of-the-road effort on everything else, and that's okay. If that's what captured their attention, it's great. Someone else is really fascinated by the investing side of things, and so they've gone into a lot of detail finding out different stock and bond options, different types of retirement accounts. And so it's been interesting so far for me to see what different directions students have gone in. As it says here, it's worth 15% of your course grade, so it's an important thing. It's almost as much as all the homework you've done this semester. I think all of the homework you've done is 20%. And if you think about the hours and hours you've spent on the homework assignments, then that maybe could give you an idea of the budget of time that's appropriate for the project. It's not the sort of thing that probably you could do the project in 3 or 4 hours. I don't think so. All right, so if you have questions along the way, feel free to stop by my office or call me on Teams, or you can send me an email, and I'll do my best to assist you. So we're continuing talking about inflation today, and I wanted to start by showing you the unemployment rate. And the reason why is that inflation and deflation are in large part tied to employment cycles. And shaded in gray are periods of recession. This is similar to a different figure that I showed you in our previous class meeting, where I mentioned that, for example, this period of recession had to do with September 11th. This period of recession had to do with the housing bubble that popped in 2008. And then this most recent recession had to do with COVID. And what's really, I think, amazed a lot of people is how short that period of economic contraction was. Things got back to normal a lot more quickly than anybody had expected. You can see that the unemployment rate spiked to kind of historic levels, at least in terms of modern day. Of course, during the Great Depression, unemployment was much higher than this. But what's kind of remarkable is it's the area under the curve that is suffering. It's not just how high it gets, but it's how sustained is the unemployment. So you might think of the area under the curve after the housing bubble. You know, that's a lot of economic pain, a lot of people whose lives were disrupted, and there definitely have been people whose lives have been disrupted from COVID, but at least in an economic sense, the area under that curve appears to be less than what people suffered about a decade ago. So as far as inflation goes, remember the relationship that when unemployment is high, what that means is that there's less pressure on the economy because there aren't as many dollars chasing fewer goods. But when unemployment is low, wages are relatively higher, and then you have more dollars chasing the same number of goods. Now, part of the reason why we're experiencing inflation these days, right at this moment in time, is because there's so many supply chain disruptions that not only do people have more money than they usually do because of the economic stimulus payments, so that's part of it. That's only half the story, though. It's also because, you know, a lot of what we want to purchase is sitting in container ships off the coast of California. You've probably driven by the Toyota dealership over by the mall and just seen how empty it is there. I drove past the Subaru dealer the other day, and it looked to me like they only had 3 cars in the parking lot for sale. And that's, I think, down from usually more than 100. So there's just the same number of people who need to buy cars. You know, cars are breaking down at the same rate that they always have, but there's less things available. I had the misfortune of buying a used car too in the last year, and the used car market is equally really under a lot of pressure. Just people selling absolute garbage for premium prices, just junk. If you wanted to sell a car, now's the time to do it because people are really desperate. So unemployment rate is part of that cycle, and we're going to talk about the deflationary spiral. Deflation is the opposite of inflation. So remember, in inflation, what it is there's more money in the economy, and so the value of any individual dollar is less in terms of purchasing power. Deflation says that prices are falling rather than rising. And I mentioned how initially that sounds like a good thing, but it can have some insidious effects. If money becomes more valuable, you're less likely to spend it because you think, I can buy more things tomorrow than I can buy today. I'll just put off my purchase. And so that's kind of the risk of deflation, is that lots of people get that same idea, that maybe I'll just delay buying because in the future prices will be lower and I can purchase more. And so the reason why that's problematic when you're in the deflationary spiral is that the falling demand, because of what people have in their mind, people are thinking, I'll buy a computer in 6 months, not tomorrow. Because the computer in 6 months will have a better processor, it'll be a little cheaper. Or maybe people are thinking that lumber that I need to buy, the 2x4s, which are like $6 now, maybe the prices will go down to $5. So I'll just wait. So when there's less demand, then that suppresses the prices. Because remember, our relationship is that if there's high demand, prices go up just because of the response that when there is more money chasing the same number of things, then the resellers will raise the price to kind of weed out who wants it more versus who wants it less, and because they can. But when they want to stimulate demand, the way that a retailer would do that would be lowering the price. And so falling demand causes people who are selling things to lower their prices because they're trying to get people in the store. But then what happens with the falling prices? That means that they may not make as much revenue as they ordinarily do. Not only because there's less demand, but also because the prices are lower. So revenue is the product of those two things. Remember, revenue is the number of units sold multiplied by the purchase price. And so when both of those things are lower than they were before, when you're selling fewer things and the things that you are selling are at a lower price, that puts your company at risk. You have less revenue, so you may not be able to make the payments on your rent, may not be able to make the payments on the debts that you've acquired. And so these companies are going out of business. There's more defaults. And bankruptcy is when a company sometimes decides to just stop operations entirely. But in other cases, bankruptcy is just that they're going to continue operating, but they're wiping their debt sheet clean. Their creditors only get a portion of the amount that was owed to them. And when that happens, there are layoffs and wage reductions. Because when a company is going through reorganization and restructuring because of a bankruptcy, part of that process is that they have to show how they're going to be more competitive in the future. And that usually means that they're going to be smaller than they used to be. Because if there's less demand, your company doesn't need to be as large. And so there's less demand, your company's going to be making fewer things, you don't need as many employees. So you've laid off people, you've reduced their wages, because now when there's a bankruptcy, all of the previous agreements that you may have with your labor unions are typically thrown out, and it's, kind of a free-all for renegotiating wages and labor contracts. So the people who do still have jobs may be earning less, and some of the employees have been let go, and since all of those people are getting less money than they used to, then that causes the demand to go down. Because if you're making now $12 an hour instead of $15, you're going to have to start tightening the belt and spending less money. So then the cycle continues more and more. So deflation is something to be avoided. And we looked at the graph from the modern economic age. The Federal Reserve Bank has been pretty effective in preventing deflation because it's so dangerous. People just things seem to run better when inflation is between 1 and 2%. But deflation has a lot of psychological unintended consequences as people put off purchases because not only maybe prices will be lower in the future, but also people begin to feel uncertain about the job security. And so that's another contributing factor to why they maybe would put off their purchases. And that further reinforces this deflationary spiral. So we've talked about that deflationary spiral, and you're going to have a couple of concept questions on your final exam. I've only given you one concept question on the midterms, but on the final exam, we've got a little bit more time. So you should be prepared to respond to short answer questions, and I consider this cycle to be very fertile ground for concept questions. All right, this figure illustrates the decline in savings rates over a couple of decades, and I remember back in the mid-'80s when interest rates were relatively high. And even with just a savings account, you could open an account and make 5% in a savings account, compared to these days where maybe 1% is at the high end of things in a savings account. So part of the reason why savings rates have decreased is because back in the 80s, inflation was higher as well. So that's another thing that's tied to inflation, is the rate that banks pay for savings account and the rate that they charge for loans. Market adjusted interest rate, just to refresh your memory, this variable I sub f, we sometimes call that the inflation adjusted interest rate, and the other name for it is the market interest rate, because that's just the rate that a bank would charge to borrow their money, or it's the rate that a bank would pay when you save money. And they don't come right out and publish what is the real interest rate. They don't make any mention of what the inflation rate is. It's just the interest rate that you're getting is what you get, and your real interest rate might be negative. This shows the real interest rates. And so real interest rate is the I. Market interest rate is I sub F. So remember that when the inflation rate is bigger than the market interest rate, then the real interest rate is negative. And that's been the case since about 2010, that real interest rates have been negative, meaning that the longer you leave money in just an ordinary savings account, the less your purchasing power is going to be with those dollars that you've saved. The market interest rate can be more than the inflation rate if you're fortunate, and when that is, then your purchasing power increases because the real interest rate is positive. But nowadays, the market interest rate is less than inflation, which means that your purchasing power decreases and the real interest rate is negative. And for obvious reasons, they would rarely quote what your real interest rate is, because if they advertise that you're going to be losing money by depositing your funds with us, then people would maybe be a little bit reluctant to save in a bank CD or savings account. They'd probably look elsewhere for returns like bonds, or the government will allow you to deposit a certain $10,000 each year in something called an I bond. And the I bond is tied to inflation, and it kind of ensures that you'll never have a negative real interest rate, because the I bond is some positive real interest rate plus the rate of inflation. But unfortunately, you can only deposit $10,000 a year into the Treasury's I bonds, and then the other bonds that they sell kind of also have a negative interest rate these days. Now, when we are doing future worth calculations, there are two ways to account for inflation. And this is a little bit tricky. Our textbook has a table that goes into a little bit more detail in explaining this. And of course, today's in-class exercise, I try and make these points in a different way, illustrate the effects of a negative real interest rate. But when you're trying to find out what happens for future dollars, then you can convert all of the cash flows in a business opportunity to constant value dollars. Now, when you're doing that, what it means is that you would discount future costs at the inflation rate F. So what you're effectively doing here in option 1 is you're trying to cancel out the effect of inflation by discounting at F, and then you would use the desired real interest rate that you hope to achieve in calculating the future amounts. So it's kind of like, if you know what your operating expenses are in the future, you discount them to the present using F, the inflation rate, and then if you wanted to know what is the future value of that economic opportunity at a certain real interest rate, you'd compound that to the future at I. The other option is to just leave those future costs and revenues inflated, meaning at the value that will be encountered at the time that it actually occurs, and then use the inflation adjusted interest rate when you're calculating future amounts. So I illustrate both of those today when we go through the in-class exercise. Remember capital recovery and what that means. Capital recovery is the difference between the purchase price and the salvage value expressed on an annual basis. So if you buy a piece of equipment at time 0, keep it for a certain number of years, and then dispose of the equipment at the salvage value at some future date, then capital recovery is how you calculate what amount each year is required to cover that equipment. The difference between the inflow and the outflow. The capital recovery is an annualized amount. So the money that you purchase the item with, today's money, is more valuable than the dollars that you're recovering in the future. So you should use the capital recovery calculations, use the I sub f, because that's going to take into account both the effect of those future dollars being less valuable and the real interest rate that you hope to earn. And so in the capital recovery, you're going to take the annualized amount of some present value, and then also you annualize the future value of the salvage. So the I that you'd substitute into that equation is I sub f. Okay, so let's work on the in-class exercise. In today's in-class exercise, we have two problems that illustrate the effects of inflation. And you can see the formulas I've given you here is the market interest rate formula, as well as the formula that we use to find a future value based on a present amount. So let's just first of all go through part one. And of course, you're welcome to work together and talk. You know, it doesn't have to be silent time in here. But there's two different rates that are described in this problem statement. The inflation rate, F, remember lowercase f is the inflation rate, is 3%, 0.03. But then the rate that is paid by the bank is 1.25%. And so that is I sub f. All right, let me pause for a second so you can read through these problems and begin your calculations. All right, so in this problem, the market interest rate is 1.25%. And these definitions you need to commit to memory. The interest that is actually being paid, that's called the market interest rate, I sub f. And the inflation rate, F, is 3%. All right, so in part A, it's saying find out how many dollars will actually be in the account. So the amount of dollars that will actually be in the account is based on the interest rate that's getting paid. It's not based on inflation. It's based on what does the bank offer. So that is why we compound at 1.25% for 8 periods. So the future number of dollars, F, is going to be the 110,000, and it's experiencing 8 years of 1.25% interest. So you can see how that calculates out to $121,493. So that's how many dollars will be in the account. But how much is that worth in today's terms? The question is not how many dollars will you have, but how much equivalent purchasing power would you have in that account? So this next part, I tell you, use the inflation rate. Inflation rate is the 3%, and we already know that what we've calculated is an F. That $121,000 is an F. And so in part B, it's saying find P given F and discount that value by 3% per year. So effectively what we're doing is we're saying that $110,000, what's happening to it? Is it getting bigger in terms of its purchasing power? Is it getting smaller? And unfortunately, it's getting lower. So it's kind of showing you how much money you're losing by putting it into that account where inflation is greater than the yield that's being earned. So that $110,000 you put in would only have $95,000 worth of purchasing power in today's terms. All right, and then the last part here, what is the real interest rate? You have to know that by real interest rate, what that means is solve for I. Because I sub F is the market interest rate, F is the inflation rate, and I is the real interest rate. So we're doing a little bit of algebra here to rearrange the formula and solve for I. So this is showing how in real terms you're losing about 1.7% of purchasing power each year. And this is a pretty realistic example. The maybe only thing that's off about it is that these days we're not earning 1.25% and inflation is even higher. So if anything, we're losing more than 1.7% per year on funds that are saved in a savings account. All right, the last thing here what inflation-adjusted interest rate would the bank have to offer for you to earn a real interest rate of 1.25%? So remember what I mentioned is that banks advertise the inflation-adjusted interest rate, or it's called the market interest rate. That they advertise I sub F. But what if banks told you what your real rate of return would be? That would be a really beautiful thing, right? And that is the idea behind those government I bonds that I was telling you about, is they promise you that you're always going to earn a real rate of return of, let's say, 1%. And so they say you're going to make 1% plus inflation. So in this example, it's saying, what if you're going to earn a real interest rate of 1.25% and inflation is 3%? How much would the account actually have to pay? And so if we're solving for I sub F required in order to achieve a real rate of return of 1.25%, then that means the account should earn 1.29%. So that's part one. Any questions about these calculations? Okay. I'll leave this up for a second. I see some of you are taking notes. If you haven't already, feel free to begin on the next part of the in-class exercise, the part 2, where we're investing $550,000 in a crane. We're trying to find out how much revenue we have to receive each year to recover the investment in 5 years with a real rate of return of 9% and inflation is 5.5%. So on that in-class exercise, part 2, I give you the bullet point kind of step-by-step instructions that, first of all, you're given I and F, so calculate I sub F, and then solve for A using the I sub F that you've just calculated. Sometimes when you've got a problem like this on part 2, I think it's good to write on the right there on the paper, identify the variables. So for example, I is 9%. So you could write the letter I right next to that, and F is 5.5%. This present value is $550,000, and it doesn't tell us anything about a salvage value, so it must not have any salvage value that needs to be considered. We're just trying to find out, recovering the investment in 5 years, how much has to be earned. So let's take a look at this. First step, calculate the market interest rate. That is also known as the inflation-adjusted interest rate. So the inflation-adjusted interest rate should be 14.995. And if that's the interest rate that we use for solving A, then you can see each year you have to have net revenue of $164,054. So that's just showing how when you're using future dollars that are less valuable than your present dollars, and we know what real rate of return we want to make, and also what is the inflation. So the money that you're making in the future is going to have less value than the dollars you spend today. And that's why we account for both the inflation rate and also the real interest rate that we hope to achieve when we're calculating A, is because we have to make even more dollars in the future than we would otherwise if there wasn't inflation. Okay, well that's all I have for you today. Remember that the big thing on your plate is the project, and the little thing on your plate is homework 13. Have a good weekend. I'll see you on Monday.